From Tycoon U Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
And now it's time to go over some basic option strategies. You've learned everything up until now, and let me tell you, it's not going to get harder. In fact, it's going to get easier. Basically, everything that you learned up till now gives you the ability to completely understand what Ron's about to show you. It's like, learn to read. The first thing you're going to learn is vocabulary. Then you're going to learn to read. You're not going to do it in the reverse order, or else reading a book's going to be pretty hard and pretty confusing, right?
That's exactly right. It's an excellent analogy. If I have a good grasp of the individual words themselves, then it's easier for me to see combinations of words. If I understand options themselves, now I could start more easily commanding the use of options together and applying them into the real markets. And that's where we are right now. This progression of thought and the progression of teaching that we're going through is something that I found worked phenomenally well with floor traders, professional traders. And we're going through that exact same progression here with individual investors.
Well, isn't it amazing how with individual investors, I know you've taught plenty, I've taught plenty, that they can just learn this stuff just as easily as a floor trader learned the information that they had to learn in order to have that job where they get paid high six-figure salary.
Hey, these individual investors are no dumber than the floor traders, I guarantee that. Floor traders, we were dumb. But nobody's as dumb as we are. If we could learn it, anybody can learn it. But to really learn it well, you have to learn it the right way. And that's that natural, logical progression that this DVD set is set up in. And it's the same natural logical progression that I used to use to teach the floor traders.
So now you have the building blocks that you needed to learn what he's about to teach you. And I'm going to jump in. I'm also going to talk about some technical analysis with you. So I'm going to show you when it would be the best time to implement the basic strategies that Ron's about to show you. And I think you're going to start off with some of the most basic of basic strategies, right? Stock replacement?
I think your favorite, stock replacement, the ability to just replace a stock position with an option position that gives a major advantage in terms of cost efficiency and return on investment and risk and a number of other advantages. And yes, stock replacement is the most basic of the basic strategies.
Yeah, so it's basically going to be, stock replacement are directional plays. So basically, if you think a stock's going higher, it's a very simple strategy. If you think it's going lower, it's a simple strategy. It's what we do with the Trend Rider all the time. It's a lot better than owning stock or shorting stock. You're taking on a lot less risk, and you're actually making more money if you do it the right way.
And there is a right way and a wrong way. And hopefully that's what I'm going to show them right now with stock replacement.
All right, well, let's take care of that. What do you say?
I'll get to it right now.
Go for it.
The first strategy we're going to talk about is the stock replacement strategy. Now, this strategy should be a godsend for all of you stock traders. Why? Because with the stock replacement strategy, you are going to immediately increase your profitability and decrease your risk. And the beauty is you're not going to have to do anything differently than you don't already do trading stocks. Why are we going to use options over the stock? We've got to take a look at some of the advantages that using a call or a put would give us over trading the stock. Number one, cost efficiency. There's a lot of Googles out there. There's a lot of high-priced stocks. And a lot of you can't trade those high-priced stocks because they're too expensive. With the cost efficiency of options, the ability to decrease the price of your expenditure, your outgoing money, you might be able now to trade stocks that you could never trade before. They're also a safer alternative to shorting stocks. A lot of times we know that brokers, the SEC, different accounts, there's a whole mess of rules that can get in our way to shorting a stock. But the one thing is, everyone in every account allows you to buy a put. And that way we can get short without having to short the stock. We've got a limited loss scenario here. Remember, we are talking about buying options when we talk about stock replacement. And we know that when we buy options, we can only lose the amount of money we spent. Now, if we can only lose the amount of money we spent and we control the amount of money we spend, then we're always in control and in a position where we limit our loss, or at least we control the amount we can lose. Percentage return. Hey, it's a simple function of mathematics. If I can have two positions that are roughly equivalent in their performance, yet one cost me 60% less than the other, I'm going to have a higher rate of return. That higher rate of return means my money is working harder for me. And the key, locking in profits without reducing the position. And that is a key. If I can stick with a position all the way to fruition, allow the stock to run, and every expert will tell you, let your winners run. This allows us to let our winners run without giving us fear of loss. Most of the time when people get out of a stock too prematurely, it's because they were fearful of losing their profits, fearful of the amount of money they have in the market in principle. That is what makes people get out of their positions too early. We can eliminate that. We can lock in our profits without reducing our position. So let's take a look at the stock replacement strategy. What are we talking about here? Construction. How do we build this strategy? It's really simple. We're going to buy a call to replace a long stock position, or we're going to buy a put to replace a short stock position. Remember here, we're talking about buying options for stock replacement. We are not selling options. This is strictly a single option that we are buying. I want to buy the stock? No, I'm not buying a stock. I'm going to buy the call. I want to short the stock? Negative. I'm going to buy a put. That's all we're doing. For you stock traders out there, nothing changes. You're going to look at the same charts. You're going to look at the same news. You're going to go through the same normal progression of choosing a stock to invest in. The only difference is before you press the button that says buy stock, you're going to stop and you're going to buy a call instead. Sounds pretty easy, doesn't it? It is that easy. However, you've got to know the right call and the right put to buy. There's a lot of calls and puts out there, and you can buy the wrong one. How many of you have gone out and bought a call because you thought the stock was going up, and you buy the call, the stock goes up, and you lose money on your call? Yeah, I did that when I first started. A lot of people do that. You get enticed by that really cheap dollar option. You know, that way out of the money option? And you buy that one. The stock runs up, but not enough. Or the stock runs up, but it doesn't run up fast enough. And what happens? You lose your money in the call, even though the stock did exactly what you thought it was going to do. You need to know how to buy the right one. And that's what we're going to go over. So what's the function here? It's a bullish or bearish strategy. If we're bullish and we think the stock's going to go up, we're going to buy a call. If we're bearish and we think the stock's going to go down, we're going to buy a put. So whether we're bullish or bearish, we have an instrument that we can play with here in the stock replacement strategy. The nice thing is it's a fully hedged position. Remember, we can only lose the amount of money we spent. Control the amount of money you spend, you've controlled your loss. This position that we're going to put on is going to act very similarly to the stock position. Identically? No. But that could also be good. We're going to probably make 80 to 85% of what the stock makes. But it's going to cost us 60, 70% less to do it. So let's go just take a little review of calls. We want to make sure that we're strong here. Calls are a long instrument. Why are they a long instrument? Because they give us the right to become long. Think about it. A call gives you the right, but not the obligation, to buy. When we buy, we become long. A call is giving us the right to become long. It's a long instrument. The importance is that you have the right, but not the obligation. You don't have to do anything you don't want to do. You call the shots when you're the owner of the option. Risks and rewards. Why are we talking about buying and not talking about selling? Well, buyers have an unlimited potential reward and they have a limited risk. That's where we want to be. Give me the ability to make a real good amount of money if I pick the right stock, but limit my risk in case I'm wrong. That's why we're talking about buying. Why are we not talking about selling naked options? Because they have an unlimited potential risk. Stock could go to zero. Don't tell me you've never seen a stock go to zero. We've just seen a lot of stocks go to zero, and it's happened before. It will happen again. And you only have a limited reward. That means you can only make the amount of money that you got when you sold the option. If the stock runs beyond that, you miss it. Here with the call, buying the call, stock could run to infinity, and I'm playing. Moneyness. Moneyness is going to become an important topic. Now, if you look up the word moneyness, I'm not sure outside of the options market if this is actually a real word. Because I think that us option traders created the word moneyness. Because I've looked all over for it and it doesn't exist. But there is a moneyness of calls. When we talk about the moneyness of options, we're talking about, is the option in the money, trading with intrinsic value? Is it at the money, trading right around the strike? Or is it out of the money, trading only with extrinsic value, with a small percentage chance of finishing in the money with value? We need to review these because when we start deciding which call is the right call to buy when I think the stock is going to go up, it is going to be largely in part due to moneyness. Which option has the right moneyness for what I'm trying to accomplish? In the money calls, those are calls with strike prices lower than the stock price. So if I have a stock that's trading at $30, any strike in the calls below $30 is an in the money call. The 25 strike would be in the money. How much in the money? $5 in the money. The 20 strike would be in the money. How much in the money? $10 in the money. Every strike below the stock price is an in the money call. It has real, legitimate value. It has intrinsic value. The at the money calls, the call whose strike price is closest to the at the money, to the current stock price, is considered to be at the money. Now, that means our at the money call can be slightly in the money. It can also be slightly out of the money, but it is definitely the call with the strike price that's the closest to the stock. Finally, the out of the money calls. This is the one that I think we were talking about a little earlier when I said, did you ever buy a call, have the stock run up, do exactly what you thought it was going to do, and have the call expire worthless, lose all your money? I bet you that you bought an out of the money call when you did that. Out of the money calls have strike prices higher than the stock price. So with that stock price of 30, a call with the 35 strike, that's out of the money. A call with the 40 strike, that's out of the money. They have smaller percentage chances of finishing in the money. They don't mimic the stock much. There's not a high degree of percent change, and we're going to be needing that. Let's take a look at our profit and loss of a call. The first thing you need to know is your break even. How far does the stock have to go up before I start making money? Easy formula. Strike price plus the call price. If I buy the 30 calls for $4, my break even is the strike price of 30 plus the call price of 4. My break even is 34. At expiration, the stock must be 34 for me to have broken even. Below 34, I'm going to lose some money. Above 34, I'm going to be making money. Now, do understand, that is by expiration. If the stock jumps up quickly, I very much stand a chance of making money because my decay has not hit me yet. I still have extrinsic value in that option, and the stock might have moved quick enough to give me a fast profit where I can get out well before expiration. Point of maximum profit. Where does a call max out our profit? Infinity. As high as that stock will go, that call price will climb with it. No matter where the stock goes, your call is going with it. That's only for a long call. Remember, if I decide to try to sell an option, I only collect what I sold it for. So if the stock continued to run and I decided I'm going to sell puts instead of buying the call, if the stock continues to run, you miss out on all of it. You want to be buying the call here. So our stock price, our point of maximum profit, is a stock price to infinity. As high as that stock goes, we're making money on our call. Point of maximum loss. That occurs at the strike price or below at expiration. Now, there's very 100% rules of thumb in the market at all, and there's even fewer in the options market. However, there is a rule of thumb here. Whenever you own an option, the absolute worst place for the stock to go at expiration is directly at the strike price of the option. If I own the 30 strike, the last place I want to see that stock at expiration is 30. I want to see that stock price as far above 30 as possible. So, write that one down. When you own an option, the last place you want the stock to go is directly to the strike price of the option you own. Keep that in mind. Now, when we look at these break-evens, it's going to be important. Understanding how the break-evens of an in-the-money option, an at-the-money option, and an out-of-the-money option work is very important, because that tells us how much the stock has to outperform before we start making money. I don't want the stock to have to go up $10 before I start making money. You're going to notice that with the break-evens of those out-of-the-money options, you're going to have that type of situation occur. I want to start making money pretty quickly. I can live with the stock having to go up, $1 or so before I start making money on my call. But having to go up $10? No. Here's a chart of a long call. Couple things we need to look at. Number one, our limited risk. There's our limited risk scenario. Once we hit that strike price, we've lost everything we're going to lose. No matter how far further down the stock goes, doesn't matter. We lost what we're going to lose at the strike price. Below, doesn't matter. It would matter if you were long the stock, though, wouldn't it? If you were long the stock, this line would continue straight down this way with an arrow pointing straight to hell, wouldn't it? That would be a major problem. A major problem, because then our loss would be unlimited, at least down to zero. That could be a big number. Here, we have a definite, limited, fixed loss situation. And the beauty of that is I can control this loss here. Point right there. What is that point? That is our break-even number. Strike price plus option price is going to put me right there. That's my break-even. Below this break-even, I'm losing money until I hit my what? Point of maximum loss. Above this break-even, I'm making money up to the moon. Let's talk about our potential returns here. As a stock trades up, you will profit dollar for dollar over your break-even at expiration. Well, if the stock runs $10 and your break-even was up 2, then you just made 8. It's that easy. Buying the call is going to give you a major advantage over buying the stock outright. So as the stock trades up, you're going to profit dollar for dollar over your break-even at expiration. Now, do understand that when you buy any call at all, you've got 3 things that are going to affect the price. The movement of the stock, the movement of volatility, and the passage of time. And if we're talking about a stock going up, we know that normally when a stock goes up, volatility decreases. That can be a problem because if we're an option buyer, we're becoming long volatility. And if volatility decreases while we're long it, we're losing money. So normally what happens is that when the stock does trade up, our stock movement helps our position because we're long delta. And if the stock goes up, we're going to be making money. But quite often, volatility decreases, time always passes. These two combined to take away some of our profits. And if we're trying to trade the stock, we want to maximize the stock movement, minimize volatility and time decay, theta, vega, and theta. There is a way of doing that if you choose the right option. Now, our return is simple. It's going to be calculated by dividing our profits by our initial investment. You're going to notice that you're going to have a similar amount of profits to what you would have done in the stock. The major difference is going to be this number. Our initial investment is going to be much smaller than the stock traders. The stock trader is going to be putting out a lot of cash. We're not. So if we're going to get a very similar profit as the stock trader, but we do it with a heck of a lot less money up, our return is going to be much larger than the guy trading the stock. Little return example. Stock price is 60. We buy the $55 call for $6. Quickly, how much intrinsic value is there? The strike price is below the stock price, right? This is an in-the-money option. How far below? $5. There's $5 of intrinsic value here. But it's trading for $6. That means there's an extra dollar in here. $5 of intrinsic value, $1 of extrinsic value. We have $1 of decay in this option coming up. What's our maximum potential gain? Unlimited. This option will continue to gain in profits as long as this stock continues to go up. It never stops. What's our percentage return? Obviously unlimited. If the stock can keep going up, our return can keep growing. What's our maximum loss? Our maximum loss is $6, the amount we spent on the option. Where does that max loss occur? Well, think about that. One of the very few rules of thumb that I said, 100% rules of thumb. What I say? The last place you want the stock to go when you're long an option is to the strike of that option at expiration. The last place we want to go is $55. If the stock goes to $55, our call will be worthless and we will have lost all $6 of our investment. 55 and of course anywhere below. But remember, anywhere below, even if it's $20, we still only lose $6. If we were in the stock, we would have lost an additional $35 down to $20. Let's take a look at our Greeks. Well, when we're long a call, we're going to be long delta. Stock is long delta, or long stock is long delta. Our call is going to be long delta. We want to try to match the delta of the stock. We have long stock equals long delta, long call gives us long delta. Now we have a gamma position here, don't we? We bought an option. When we acquire options, we acquire long gamma. So we've got long gamma here. We also have a theta position, don't we? Remember, in that last example, buying the 55 call for $6, $5 of intrinsic, that doesn't decay. But it was a $6 option. $1 of extrinsic value. That $1 of extrinsic value is subject to theta, time decay. So we are going to have a short theta, a negative theta, meaning that we're going to lose money on a daily basis with the passage of time, all other things being equal. And we also have a long vega. Remember, when we buy options, doesn't matter put or call, when we buy options, we acquire long vega. That means that if volatility increases, we benefit. Volatility decreases, we get hurt. And what do we know about most stocks, most indexes, most anything? When it goes up, vol goes down. So right off the bat, I've got two things working, one of them definitely against me, because time only moves in one direction, at least for most of you. I've got it going backwards a bit. My last two birthdays prove that. What do we have here? We know that time is always hurting us. We need to control that. There are ways of controlling that. We also know that any type of decrease in volatility will hurt us. And the odds are in favor of the stock going up, volatility decreasing. So we have one situation that will definitely hurt us, another situation that's going to probably hurt us. And you might say, well, with all those different options and all those different strategies, can't you create another strategy that offsets these? Yes, but that will limit my upside potential. Maybe there's another way of doing it. Maybe with my knowledge of the Greeks and now your knowledge of the Greeks, maybe you know something about the characteristics of these two strike-based Greeks. They're based upon the strike. And what does that mean? They're highest at the money. And they decrease as you move either further in the money or further out of the money. Maybe we can control these things by picking the right option instead of adding on to the position and decreasing our unlimited potential upside. Here's our Greeks right here. What do we have? We are long delta. We see that we actually increase as we go up. Once we hit that break even, we get very aggressive to the upside. We know that's our gamma. We know we are long theta and we are short theta and we are long vega. As the stock trades up, I don't know, maybe 85% of the time, 90% of the time, vol will decrease. And we know that 100% of the time, theta, time decay, will be hurting us. We need to get beyond this break even. This stock has to perform not only to the break even, but then beyond the break even. It's important then to keep this break even as close to here, this dead center zero line, as possible. We don't want break evens out here. The stock would have to move too much just to get the break even. I want that break even in here. Not even out there. I want it in here. There's a certain option that creates a lower break even. We'll take a look at that. What can I do to protect myself? Oh, Ron, you could throw a stop order in. Correct. But we know that that only works intraday. We know that if we wake up one morning and our stock's looking down 60%, 70%, that stop order is not going to work. We're going to get the opening price. We're going to lose a ton of money. The stop order doesn't work. The only true way to really protect the stock is to use the ultimate hedge, options. So what do? We buy the stock and we buy a put to protect the stock. And if I showed you that position, you're like, yep, that's protected. My long stock is protected by my long put. If the stock falls so much, no big deal. I exercise my put, giving me the right to sell that stock out to somebody else. Correct. Now, going back here a second, that's this. Your call is actually long stock and long a put. If the way you protect a long stock position is to buy a put, then what you've just done is created a call. The difference is you put all that money out for the stock when you didn't need to. The chart of a stock would look very much similar up this way. The difference is as it came down, the arrow would point this way. By buying a put right here at this strike, we take that stock chart and bend it this way, right? We've limited the potential loss. We've limited our downside. So I have my stock chart looking like this. I add the put in, it takes the stock chart and bends it like this. It creates a call. The call is like having the stock and a put. The call must be safer than the stock because the way that you would protect your stock, the best protection you could ever have for your stock is to buy a put for it. If you buy the stock and buy the put, you've just created a call. Why didn't you just save the money and buy the call to begin with? Because you didn't know what to do or how to do it. That's what we're here to discuss. So if anybody ever asks, and you say, yeah, I'm trading options, they say, oh, they're risky, say, wrong. They are safer than stock because I can prove it, and I just proved it to you. Owning the stock and buying a put for protection is the same thing as buying the call. The call has to be safer than the stock outright because it includes the put in it. The call has its own natural stop. Long stock, long put. That's a call. So how do we price this thing by the corresponding call? Well, if we have a situation where we look at the synthetics of this, you take your put, you add the interest, you subtract the dividend. That is going to give you the value of the call. Remember, calls always trade higher than the put by the amount of cost of carry. Interest minus dividend. So what we're going to see is our call is going to be trading higher than the corresponding put. By how much? Interest minus dividend. That's how you know whether the two options are in line with each other. So let's talk about how it works. As the stock trades up, our call price is going to gain value by the amount of the delta. Now, we know there's more factors that affect stock price than just delta. But let's just start out with how we're going to make money first, and then we'll worry about how we're not going to lose it. As the stock trades up, that call is going to gain by the amount of delta. As the stock trades up, that delta is going to increase. So the more the stock trades up, the more we're going to start making money. We'll make a little bit of money at first, but we'll eventually start at some point in time when this options delta goes to 100, this call will actually start making dollar for dollar with the stock. If volatility increases as the stock is trading up, maybe there's rumors of a takeover, who knows? But if volatility increases, our call will increase in value by the amount of its vega. We're going to be long vega. When we're long vega, it means that we make money when volatility increases. So we've got the stock price moving up for us. That makes us money. We've got volatility increases. Although rare when the stock goes up, it does happen. But if volatility does increase, our call's price will increase by the amount of the vega. But no matter how much money the stock makes via the delta, your option makes, no matter how much you make via the vega, time always hurts you. Time waits for no one. What it's going to do is it's going to decay. So do understand, even with everything going right, time is still working against you. Now we have to look at the losses, the unfortunate part of this business, but something that happens. It's a part of the business. As the stock price starts trading down, obviously our call price will decrease by the amount of the delta. The nice thing is here is that even though we're going to be losing money, we could have had a long stock position. That long stock position would lose a lot more on the way down than the call would. Why? Because as the stock moves down, we know the delta of our call decreases. It starts mimicking the stock less and less. That means it'll lose money slower than our stock would. Volatility decreasing could also hurt us. Our call price decreases by the amount of vega when our volatility decreases. Remember, when we have a long option, when vol goes up, the value of that call increases along with every other option. The problem is that when volatility decreases, the value of that call will decrease. And we know that when the stock goes up, the likelihood of volatility decreasing is much higher than the likelihood of the volatility increasing. odds are, in this position, volatility will probably hurt us. Time again is time. It's going to pass. It's going to go one direction. When you're long an option, time is always an enemy. So what we're going to try to do to alleviate these two problems here, we're going to try to pick a certain option that will not be very volatility sensitive and will not be very theta sensitive. So when are we going to do it? When are we going to buy these long calls? Whenever you think a stock is going to go up. If you have a reason to buy the stock, then you've got the better reason to buy the call. It doesn't matter. It's not like a specific only if the stock is going to go up like this or like that. Anytime that you would naturally buy the call, anytime that you would naturally buy the stock, you should definitely want to buy the call. Remember, that call is less costly. It's got less risk. And what else? It's got a better percentage return. You definitely want to buy the call whenever you're thinking about buying the stock. Obviously, the stock has to be going up. We don't want to look at a chart, see a stock that has no reason to go up, and buy the call. The stock has to be in a position where we think it's going up. We're looking at our charts. We see a nice pattern developing that indicates rising prices. We say to ourselves, okay, the stock is probably going up from here. What do? We buy the call. This is a great time to use long calls when the stock is a high-priced stock. Google's tough to trade. Why? Because it's a $450 stock. It's sometimes a $600 stock. Anytime we're looking at a high-priced stock, Apple, RIM, anything that's a high-priced stock, sometimes it just prices us out of our ability to trade it because it's too expensive. It costs us too much money to put a position on. Remember the cost efficiency of options. Because we have cost efficiency working for us, we can easily buy a call where we might not have easily been able to buy the stock. So we definitely want to use the calls in high-priced stock situations. The other thing that's important is I've heard so many people say, oh yeah, I bought this stock when? And then the stock runs up and they think they're the heroes of the world, and then the stock comes back down. And when the stock comes back down, all that profit that they had 6 months ago, 9 months, 4 years ago, it's all gone. Whenever you realize, the moment you realize that locking in your profits is as important as making them to begin with, you want to use a call. Because when we use the call, we have the ability to lock in profits while still maintaining our position. You can't do that with the underlying security. With the underlying security, the stock, for instance, the only way to lock in your profits is to sell the stock. You've got to sell the stock. When you do that, you diminish the size of your position. Any further movement up, you miss out on. Not true with options. When you own the call, you could actually roll the call. And we're going to talk about the rolling technique. You can roll the call up with the stock, constantly locking in profits, but maintaining your position, not missing further upside action. Let's review our puts. Puts are a short instrument. We're not talking about selling the puts. We're talking about buying the puts. Why are puts a short instrument? Because the owner of the put has the right but not the obligation to sell, to get short. So my ownership of a put, although making me long the put, is actually making me short deltas in my position because I now own the right to sell the stock at some point in time. I own the right but not the obligation through my long put to get short. And like I said, it's funny because I have discussions with people sometimes, and I tell them about buying the put, now you're short. And they say, well, wait a second, Ron, if I bought the put, I'm long it. I'm like, yeah, but now you're short. What they have to understand is, yes, when you buy the put, you're owning the put, you're long the put, but your position is now short delta. We want to buy puts to become short. The beauty of this is we can do this in any account. No matter what account you have, no matter where that account is, they will allow you to buy puts because your risk is limited. Your risk is simply what you spent on the put. This is the easiest way for an investor to get short in the market. It's not only the easiest way to get short, it's the safest way to get short. We're talking about buying these puts. What do we have in terms of risk reward in buying the puts? If you look, it's basically, in terms of a generalized situation, it's the same mechanism as being long the calls. When I buy the puts, I have an unlimited potential reward. The further the stock goes down, the more money I make. It never ends until the stock hits zero. That's a little different with a call. Calls obviously have an infinite ability to run up. Stocks can only go down to zero, so the puts only can make money in an unlimited fashion down to zero, which kind of gives it a limited situation. But my unlimited potential reward situation and limited risk situation gives me the ability to be very comfortable and confident getting short. I can control my risk. The amount of money that I have out there is the amount of money that I can lose, and that's it. Not a dime more. So I can control my risk to the penny, and I have the potential for big profits on the way down. Sellers of the puts, on the other hand, don't have the buyer's risk-reward scenario. They have a different one. They have a limited potential reward, and they have an unlimited risk. This is why we're not talking about selling options. We don't want to ever have that unlimited risk scenario, a situation where we're unhedged. The long put has a built-in hedge. So we're talking about buying these puts to take the place of a short stock position. Obviously, puts have moneyness. Still not sure if that's a real word, but I'm going to use it anyway. Moneyness. What are we talking about when we talk about moneyness? We're talking about in the money, at the money, and out of the money. We need to know how to define different types of puts. And here's one of the ways. First, let's talk about the in the money puts. That is a put whose strike price is higher than the current stock price. Say if the stock was trading at $60, and I'm talking about the 70 strike. The 70 strike would be a put with a strike price higher than the stock. The 70 strike put gives me the right to sell the stock at 70, a stock that's currently trading at 60. If I have the right to sell something at 70 that's currently in the market trading for 60, I could exercise my rights to sell at 70, then go into the open market and buy that back at 60. There's a $10 real innate value to that option. That's intrinsic value. And only in the money options have that intrinsic value. So any strike above the stock price is an in the money put. If the stock is at 60, the 65 puts are in the money. In the money by how much? $5. The 70s are in the money. By how much? $10. The 75s are in the money. By how much? $15. So an in-the-money put, puts with strike prices higher than the current stock price. At-the-money puts. We know that an at-the-money put is a put whose strike price is the closest to the current stock price. Now, that doesn't mean it's going to be exactly the same. So our at-the-money puts could actually be slightly in the money, or they could be actually slightly out of the money. But if the strike price of that put is the closest one to the current stock, that is your at-the-money put. Finally, we have our out-of-the-money puts. Any put with a strike price lower than the current stock price. That means with that current stock price of 60, we said the in-the-monies were the puts with the higher strikes, 65, 70, 75. For out of the money, we're heading the other way. With a stock price of 60, we're looking at the 55 strike, the 50 strike, the 45 strike. Those strikes all have a lower strike price than the stock price. That means they're out of the money. They trade with only extrinsic value. They have absolutely zero intrinsic value. They have no real innate value. Here's a chart of our long put. As you can see, when the stock goes down, we have an unlimited potential profit. Okay, it's limited to the stock price of 0. But if that's Google, that's a heck of a long way. We see our break even. That's the point where what? Our position has to get to by expiration to make sure we haven't lost any money. Above or below the break even, as this case might be. Below the break even point, we're making money. Above the break even point, we're losing money. We're going to be losing money up to the point of our long strike. Where is the worst place for the stock to go for all of us who are long options? The strike price of our long option. At that point, we have hit our point of maximum loss. The nice thing is we can't lose any more than that. There is our limited loss potential. Now, it doesn't matter where the stock goes. Stock can go to 100, 500, 2 million, 50 billion. It doesn't matter. We have a limited locked loss, a maximum on that loss because we own the option. And what is that amount? Correct. The amount that you spent. So let's talk about potential returns here. As the stock trades down, once we get beyond the break-even point, our put is going to make dollar for dollar with the stock. So if we can keep our break-even point tight to where the stock currently is, the stock won't have to move much until we start really making serious money with our put. So we're going to profit dollar for dollar below the break-even at expiration. This is why it's so important to really control that break-even price. Now, profit of your put is going to be determined by 3 things, like everything else. It's going to be determined by stock movement, volatility movement, and the passage of time. Now, obviously, the stock going down is going to help us. You're going to see a little difference between the call and the put when we talk about volatility. Obviously, no difference when we talk about the passage of time. Our return is going to be simple, calculated by dividing what we made by what we invested. Simple return calculation. Let's take a look at an example here. What are we going to do? We're going to have a stock price of $60. We're going to buy the 65 put for $6. Now, is this an in the money or out of the money? Or at the money option? Well, its strike price is higher than the current stock price. That means, by definition, this is an in the money put. This put gives us the right to sell the stock at 65. If the stock is currently trading at 60, we sell it at 65. There's a $5 value there, a $5 innate value, $5 of intrinsic value. But the put's trading for $6. Well, if it's got $5 of intrinsic, but it's trading for $6, that last dollar must be extrinsic value. So we have $1 of extrinsic value here. What's our maximum potential gain? Well, with a call, it was going to be unlimited because the stock could trade theoretically to infinity. But with a put, there is an actual maximum gain. Why is there a maximum gain? Because the stock can only trade down to 0. What are we looking for now? First thing we have to find to determine our maximum gain is our break even. Because we know from our break even down to 0 would be our maximum gain. The put will gain dollar for dollar at expiration from the break even on down to 0. We need our break even. How do we determine our break even? For a put, strike price minus the option price. With a call, it was strike price plus option price. With a put, it's the other. strike price minus option price. 65 minus 6 gives us 59. Our break even is at 59. From 59 on down to 0, we wind up making dollar for dollar. $59 of maximum gain on this position. What would our return be? Pretty obnoxious. That's what our return would be. If we spent $6 and the stock went to 0, our potential maximum return would be somewhere around 983%. It looks ridiculous, but I do have some friends of mine that actually did this with both Bear Stearns and Lehman, and a couple of them's percentage return was higher than that. And you might say, how in the heck could they follow a stock all the way down to 0? That's insane. At some point in time, they had way too much profit in the market at risk. That was careless and reckless of them. What were they, cowboys? No. They were rolling. We'll get to that. They were rolling. They weren't doing the wrong thing. They weren't being too risky because they were constantly removing their profits out of the market, decreasing the risk, allowing them to follow both of those two stocks straight to 0. What's our potential maximum loss? I don't know. How much did we spend? We spent $6. We spent $6. The most we can lose is $6. Remember, when we're buying options, we can only lose the amount of money we spent. This is great for risk management. This might be the best risk management tool out there. If I know I can only lose the total amount of money I spent, and I'm the one who controls how much money I spend, then I can control my total risk to the penny. That's why we're talking about buying calls to replace long stock, buying puts to replace short stock positions. Let's look at our Greeks here. Well, we know that although we are long the put, we own the put gives us a short delta. It gives us the right to become short. So, these puts give us a short delta position, allowing us to trade the downside with limited risk in a cost-efficient way. You can't ask for anything more than that. What kind of gamma does a long put have? Well, we do know that we are buying this option, aren't we? And when we buy the option, we know we acquire a long gamma position. Whenever you buy an option, you acquire long gamma. However, when you buy an option, you are bringing in extrinsic value. You own extrinsic value. And we know that that extrinsic value is subject to decay, isn't it? That means every day, day after day, time goes by, this option will lose some of that extrinsic value due to our friend theta, time decay. That means that when we're long the option, we're short time decay. It's a negative value. It's an amount of money that we lose. Vega. We're going to be long Vega here. Why? Because whenever we buy an option, we acquire long volatility exposure. Now, this was something we were worried about when we bought a call, because we said that the natural order of things is that when a stock trades up, volatility normally goes down. And we said that if we were buying the call, there was a chance that although we'd make money off the delta, off the stock direction component of the option, we know we're going to lose money in theta, we're probably going to lose money in Vega. Because when the stock goes up for our call to gain value, we're probably going to see a decrease in volatility. But this isn't a call. This is a put. And it benefits from the stock going down. So when the stock goes down, our delta is very happy. It's making us money. We know that no matter what happens, we're going to have some theta. We're going to have decay. Whenever you own an option, any option, time always works against you. But Vega is a little different here, because where a stock going up normally sees a decrease in volatility, a stock going down normally sees what? An increase in volatility. That means that as the stock goes down, we actually have a better than average chance of seeing our Vega make us money. Because as the stock is going down, volatility normally increases. And as the volatility increases, the extrinsic value in our option is going to increase when volatility expands. How much does it increase? The amount of our vega. So here with the put, our vega actually stands a better than average chance of helping us, while in the call, the vega stands a better than average chance of hurting us. So there's a little bit of an advantage here. When we look at the construction of the long put in terms of its synthetics, the long put is synthetically the same as shorting the stock and buying the corresponding call. Now remember how I told you that when it comes to a risk scenario, the actual long call is much safer than buying the stock. The long put is much safer than shorting the stock. Let's go back to our chart here. Here's a chart of the long put. Now, if I was going to construct the perfect hedge for a short stock position, because remember, a short stock chart would look what? Like this. Arrow going up this way like this, but the same on the other side. I'd have an unlimited potential gain in a short stock position, but I also have an unlimited potential loss in a short stock position. That's a lot of risk. So if I asked you how could you hedge that, you might say, Ron, buy a call. By buying the call, giving me the right to buy the stock, I can buy my short stock position back, and that will limit my loss. So if I did that, I would take the chart of my short stock, add this call, which what? Flattens out my risk, takes my risk from unlimited to limited, and what do I have? Now I have a put. Inside the put lies an automatic hedge. It's a short stock position with a long call hedge. The put already comes with the protection that you look for to protect your short stock position. Why waste your time selling the stock, buying the call for protection, when you could just simply buy the put to begin with? Think about all the money you're putting out in the stock. The put's not going to cost anywhere near that. Plus, you're putting out money for the call. Just simply buy the put. So the put is truly, definitely, 100% less risky than the short stock. Options, when used properly, are always less risky than the underlying security. Anybody who tells you different, you know where to find me. www.optionsgps.com. You send them over, tell them to see Ron, because I will prove mathematically how they are wrong. Options used properly are definitely less risky than the stock because they've got the automatic hedge built in. Now, we could take a look to see if our put is in line. Remember, the put might be a little expensive. We don't know. But if we look at the corresponding call, minus the interest plus the dividend, we should see the value of the put. Remember, a call will trade higher than its corresponding put by the amount of cost of carry, interest and dividend. If we take that call, subtract out the interest, add back the dividend, we should have the exact same value as that corresponding put. This way we could tell whether the call and put are in line with each other before we buy the put outright. So how does it work? As the stock trades down, put prices are going to gain in the amount of the delta of the put. Remember percent change? We know that if the stock goes down $1, delta tells us how much our put value will increase. So we've got the idea of a downward moving stock. We're going to buy the put instead, and the put will gain value off the stock movement. However, in the case of the call, we said that we've got a problem with volatility here, don't we? We said that normally volatility decreases when the stock goes up, and it's rare indeed that we might see a volatility increase and a gain from volatility. But that was with a call. Here, the put's a little different because the put is not taking advantage of the stock going up where volatility decreases. The put is taking advantage of the stock going down. And what normally happens when stocks trade down? What normally happens to volatility when stocks trade down? Volatility normally increases. There's the difference. When the stock goes up, vol normally goes down. It more than likely would hurt our call. However, here, when the stock is going down, volatility normally increases. That's going to help our put. Why? Because we're long Vega when we buy the put. In this case, we stand a better than average chance of gaining through volatility, where with the call, we had a better than average chance of losing due to volatility. So volatility is probably going to gain for us. Time, however, well, same old story. You own an option, time goes against you. Time only knows how to go in one direction. And for option owners, it's against you. What we definitely need to try to do is try to somehow isolate these two factors, Vega and Theta, and get them away from us. We don't want to have big exposure to either of these things. Even if volatility does increase, it's not a chance I want to take. In the stock replacement strategy, I want to take advantage of the downward movement of the stock. I'm looking at delta. I want to have delta. Well, there's always losses to talk about. We could be wrong. We read the chart wrong. It happens. The stock trades up instead of going down. What happens to my put price? It's going to decrease by the amount of the delta. I'm going to have a loss because the stock went in the wrong direction. And delta is my directional play. I lose money if the stock goes up when I buy the put. However, we know that normally when the stock goes down, volatility increases. But what if volatility decreases? Well, what happens when volatility decreases? Volatility decreasing shrinks the size of my extrinsic value. It takes away some of my extrinsic value, thereby decreasing the value of my put. How much? It's going to decrease the value of my put by the amount of my Vega. Vega will tell me exactly how much money my put will lose per every 1 tick decrease in volatility. But as I said, more often than not, vol is going to increase when the stock goes down. As time passes, our put price is going to decrease. The extrinsic value in my put is going to decay, definitely. So time is going to hurt me. I need to somehow figure out how I can somehow neutralize the effects of these two without giving up some of the benefits I have in the stock replacement strategy. A lot of people always say, hey, Ron, sell some premium. Sell an option that will offset the potential loss of your volatility via Vega. That'll offset some of the passage of time, the loss in Theta. The only problem is I just gave up my unlimited upside potential. I don't want to do that. There is another alternative to diminish the effects of time and volatility without having to add a short option into the mix.